Hello and welcome to the Financial Blueprint. I'm your host, Kyle Ryan, certified financial planner and co-owner of Manager and Associates, and I'm very excited to have with me today JJ from Princeton Mortgage. JJ, thanks for being with me.
Thanks for having me, Kyle. Appreciate it.
Absolutely. So, as a mortgage broker, please look at the camera, tell the listeners, viewers, what you do.
So for me, it's pretty simple. I help you secure a mortgage, whether that's 11 p.m. phone calls or bright and early phone calls. I'm always there to answer things along those lines. Not everything's going to be the same for every person, whether you're self-employed, if you're W-2, if you just started a job, you switched careers, you switched a job. There's many different avenues that we could go down.
Yeah. And you're not kidding. I've reached out to you at 7 p.m. and later on a Friday, and you have answered for my clients. So you go above and beyond. So you've been doing this for a while, right? So there's been a lot of shifts in the market, real estate market, mortgage, just the amount of options available to you. What are some of the major shifts that you've seen in your career since you started doing mortgages? Whether it's people staying in place, the availability of homes, what are some of the different changes you've seen?
Availability of homes is definitely something that needs to be talked about.
Yeah.
There's no availability for homes usually.
Yeah.
In the spring markets. When you get closer to fall, things slow down a little bit.
Okay.
Also, one thing people don't realize too is if you're selling a home and buying another one, you're worried about school districts. Well, so are the people that are selling the home that you're trying to buy.
Yep.
So a lot of people don't think about that type of stuff, and it just needs to be talked about. Sometimes you need to be able to put in an aggressive offer, not as far as price, but as far as condition.
Yep.
Whether it's a contingent offer, whether you're putting a big deposit down. More importantly, what I've noticed is, at least with some of the estate sales and things along those lines, people are more worried about how quick can you get our names off of this home? We want to be done with it. And that's where we definitely pride ourselves in being able to be speedy and efficient.
Yeah. And in our local market, Philadelphia is a hot market, especially on the outskirts of Philadelphia. Are you finding that there's availability, just a lack of it nationally, or is that just our market here in the suburbs of Philly?
So nationally, you can't compare national to outside of Philadelphia. Okay. Philly itself is a little different. There's going to be pockets of a very softer market. Yeah. Maybe not as many buyers and things along those lines, or maybe just more sellers for whatever reason. Yeah. Once you cross the 191 zip codes and you enter into the outskirts of Philly and also New Jersey, and I'll get into a Jersey story here in a minute,
okay, yeah.
But it becomes a war zone right now. And we're filming this May of 26. If anybody feels differently, they're welcome to message me. You can call me directly and I'll tell you what it's like. Yeah. But perfect example is I have a client shopping in Jersey. They put an offer in on a home. Pretty sure I could talk about their offer now because it's not going to get accepted. But the home was listed at $349.
Yeah.
Home probably should have been priced at $360, $365, but a good listing agent's going to go in and tell their client, hey, listen, we want to get as much traffic through the door. Let's lower the price a little bit, make it more appealing, get more people in, be able to pick through our offers. So this home that was listed for $349, we were putting an offer of $371.5. I specifically decided the $371.5 because I felt like if somebody else was going to use our tactic of $1,000 over $370, we're going to have $500 more.
Bump it. Yeah.
So now that's the case, it's going to be $372 next time. But so the offers were due by 5 p.m. on a Tuesday. We put the offer in Monday morning, 8, 9 o'clock. I said, listen, I'm going to get a hold of the agent, but I'm going to wait. I want to see what we're up against. And if there's anything that we need to tweak, we'll be able to tweak it. So I waited till about an hour before the offers were due, 4:10, set my alarm, called at 4:11, had a conversation, a really good conversation with the agent. What transpired next, I was not anticipating. And then to find out what the final offer was crazy as well. So talking to the agent, we have actually 23 offers on this home. My heart sank a little bit, uh-oh. So nonetheless, to make the story a little bit shorter, we didn't get our offer accepted, and we were nowhere close. They took an offer for $420.
420. That's 20%.
And this is the first time we're hearing about this. So I kept it.
Yeah.
Yes, exactly. You're actually almost completely on. But
yeah, that's wild.
It's a crazy market once you get into the market.
Yeah.
Don't be surprised if you only have one offer out there. It's not accepted. You can't just lose faith or anything along those lines. You have to really sit down with your lender, sit down with your realtor, and get a game plan.
Yeah.
I'm also noticing more and more that when speaking to realtors, they're not taking these online approvals because online approvals are useless. So I'm local, which puts me a little bit ahead of the normal market.
Okay.
I'm not a big bank. I'm going to answer on a Saturday. I'm going to answer on a Sunday.
Yes, you do.
I don't think people understand enough on how crazy the market is because they see the national averages of homes and, oh, there's all these foreclosures. Well, that's nationwide. Right now, we're blessed to have an area where people are moving out of other states to move into our metro.
Yeah.
And until you're in this market, you don't know how bad, and it's not a bad market, but how hard, I should say, it is to actually get under contract and purchase a home.
So you mentioned that, you're talking about the offer that your client's going to put forward. Are you coordinating with the buying agent as well? Or are you kind of acting almost?
I say 7 times out of 10, I coordinate with the buying agent.
Okay.
Some of them just want to know, hey, listen, let's just get this done. No problem. This is how we're going to do it.
Yep.
It could be a difference of, hey, we put on here that we're going to purchase it June 15th. Do they want June 1st? Do they want May 15th? That's today, so it's not going to work. But nonetheless, are they looking for, I know some people, I have a client who is purchasing a new build and they're not going to move in until possibly August. Their home just went on the market this week. So they're going to be in a different position.
Yeah.
Their position is going to be, hey, we want somebody who's comfortable with 3 months under contract.
Yeah.
So everything is going to be a lot different for that specific buyer. And maybe that fits some people, and other people, they just want to move right away. It's one of the things where maybe they want to sell their home and they're okay with getting a contingent offer because they're selling their home to buy another home as well.
Everyone's unique. And that's a really interesting similarity of our industries, right? You can meet anyone who comes, if it's you, if it's anyone I meet, everyone's unique. They have their own different circumstances. And it sounds like that's the case for all of your clients. You're either buying a new home, selling another home, investors. I know you work with investors. That's a whole nother can of worms, but everyone's their own animal.
Absolutely.
Right. Going back to something you said earlier, someone comes to you and they say, hey, when's the best time to buy a house? Is there an answer for that? Or is that also locally dependent and more so just based on availability?
This is going to hit the internet and it's going to ruffle some feathers, but I really think no matter who you're listening to, if you're listening to a podcast or anybody, the best time to buy a house is when you're ready to buy a house.
Perfectly.
There shouldn't be somebody holding a gun to your head to buy a house or anything along those lines. If you have some life stipulations and they're changing things, and that makes a whole different, that gun to your head is a little bit different. But whenever you're ready to purchase a house and you're able to purchase a house, that's the right time to buy. Yeah. And financially equipped, of course.
Well, on that note, you have a lot of people who say, look, I'm ready to buy this house. I found the dream home, but interest rates just went up 0.25%.
Yeah. I mean, they just went up today, literally a lot today. Yeah. So it's something where it needs to be talked about. Yeah. But here's the kicker, especially with using this Jersey offer that didn't get accepted. There's still 22 other people that are looking for a home. Yep. And I don't think we need to ignore the fact of supply and demand is a thing. Yep. So is it better to get a 7% interest rate today and get a 6% interest rate in 2 years? Or is it better to spend an extra $50,000 on a home and get that 6% at that time? Yep. I know the answer in my head. I could probably run some quick head math, but it's going to save you a lot of money to refinance that. Yes. And no rates aren't in the 7s, but we're approaching that mark right now.
Because that kind of ties to the saying that everyone knows when it comes to mortgages, right? Marry the house, date the rate.
Yeah.
Right.
That's what they say.
You find people who love the house, but it's at 7%. But if mortgage rates are expected to be lower in the future, date the rate, you could refinance your way out of it.
Yeah. And that's something I can actually give a very good, and it is a close friend of mine, and that's not why this all happened, but it was a home that was out in Solderton. Yeah. It was purchased for $432 last April to be exact. This January, they did some work to the home. They put about $30,000 or $40,000 into the home. So let's just keep that in mind. This isn't like all of a sudden it appreciated $134,000, but the appraisal came back at $565,000. Yeah. They dropped their MI, their mortgage insurance. Okay. It was like $80 a month. Yep. And they went from a 6.875 to a 6.125. Yeah. It's saving them $400 a month. Here's the best part. With refinances, you're able to get up to $2,000 back. Let's say $1,999 for argument's sake and compliance reasons. But they were able to get some money back when they refinanced. We covered the appraisal. On top of everything else, they settled April 5th and their first mortgage payment wasn't until
May. No, it would be even later. It would be June. Or I'm not.
You're just quizzing you.
Yeah, I don't know. June.
It was June 1st.
There you go, June.
But they didn't have to make their
Yeah.
April 1st payment because of how it was structured. We got a payoff through April 5th.
Yep.
So there's no late charges or anything like that. You don't get a mortgage late until 30 days of a late payment. And you don't get a late charge. That was for credit, excuse me. You don't get a late charge until the 16th of each month with a mortgage.
Interesting. It's like a little grace period.
Yeah. So we set it up. Their mortgage payment was $3,800 a month. So now it's 33 and change. So maybe it's a little bit more than 400, but.
So a huge part of that savings was not only reducing or eliminating the PMI, but also just lowering the rates in general.
Yep.
Can you explain a little bit about what PMI is, as you mentioned that?
So PMI is private mortgage insurance. What it does is it covers the difference if you were to default on your home but not have the 20% equity. The reason being is investors still want to be made whole. Let's say you bought a home and it was for $500,000 and you put 3% down. That's $15,000. To go to the 20% mark, if you were to put $100,000 down, your loan amount would be $400,000. So there's an $85,000 gap there. What the mortgage insurance covers is if you were to default, it makes sure the investor gets what they put out for the home.
Okay. And is that just an extra monthly cost that a homeowner would bear?
It's an extra monthly cost. It ranges. FHA and conventional are going to be different. FHA, if you're putting 3.5 to 9.99% down, you're going to have a mortgage insurance rate of 0.55.
Okay.
Put 10% or more down, that's going to be 0.5.
Okay. Is that something that comes up often in your conversations with people as they're discussing like, hey, I can get this 20% down. I can do as low as 3.5. I can bridge the gap. Is that something you work with them through?
Yeah. And it needs to be talked about because it's going to be hugely divided between people with good debt to income, bad debt to income. And the biggest driver, if you're going conventional, is going to be your credit score.
Yeah, I would imagine.
Yeah, absolutely. But it 100% needs to be talked about because people don't realize how inexpensive mortgage insurance is.
When I thought, because we were talking before the episode, our joke was always PMI stands for pissing money away, right?
Yeah.
Just get yourself to that 20% if you can. It sounds a lot easier than it is, right? Home prices have gone up a lot. $500,000 house, getting $100,000, it's not easy these days. So the FHA loan or even, something similar makes a lot of sense for those first time home buyers.
Absolutely.
But I've always thought, ever since I was just raised in the industry before we had a nice long conversation about it, that you really want to try and get to that 20%. Do you do anything in the 10 and 10 where someone gets a home equity line of credit? Is that a strategy?
You definitely can. It's going to depend on what you're going for.
Sure.
I actually looked into this 2 days ago, actually.
Good time.
For somebody. Yeah, didn't even realize we were going to be talking about it
just
today.
Came up.
But what I wanted to do is I wanted them to do a home equity line of credit.
Yep.
To be able to put more money down.
Okay.
And basically jumble the numbers together to where they were then going to have 20%. It doesn't always math out.
Yeah.
Sometimes just paying the mortgage insurance is going to always be the best way and make extra payments so that you get to the 78% loan to value where it'll automatically come off, but you can request it to come off at 80% loan to value.
Speaking of the request to come off, I'm going back to when we were talking about PMI a little bit. In terms of, let's say, you do an FHA, let's say you just don't get 20% down. Your home appreciates, you've been paying your mortgage off over time. Do they notify you when you no longer have to pay PMI? Or is that something sneaky under the hood that people just don't realize they're paying for years?
At 78% of the original appraised value.
Okay.
So if you've been in your home for 5 years, let's say pre-corona, and you bought a $300,000 house, probably a mansion back then, but a $300,000 house.
Yep.
$240,000 would be 80%.
Got it. Yep.
At 78%, it needs to come off automatically. Let's say
it's that long. So you build up 78% of equity of that original.
78% left.
Got it.
It automatically comes off.
Got it.
You can request it from whoever your mortgage servicer is at 80%.
That makes sense. Okay.
So you have to keep in mind, it's off of the original appraised value. It's either appraised value, it's the lesser of the two, appraised value or purchase price.
Okay.
So if it appraised at $500,000, you bought it for $300,000, they're using the $300,000.
Lord knows it's probably worth $1 million today.
Yeah. So that's something to just keep in mind, that it's not automatic, and it also doesn't follow the market. So that $300,000 house 7 years ago is, let's say, $600,000 for kicks and gigs. Well, on your paperwork, it still shows that it's a $300,000 house.
Yeah.
There is ways with some servicers that you can get a reappraisal. You have to request it. You have to pay for it yourself. It's probably $500 and $625 for an appraisal.
Yeah.
Yep. Or they'll say, hey, listen, this is the appraiser you have to use, things like that. But it can be done.
Okay.
Or depending on your rate, it's probably easier to just refinance.
So it's clear that there's a lot of complexities, right? You don't just go buy a house.
No.
It's not just that easy, right? What are some of the pain points that you have to talk new clients through? Not the seasoned investors, kind of get the gist of it. What catches people by surprise?
When I tell them that the FHA isn't always the best way to buy a home as a first-time home buyer,
That's fair.
they always think that FHA, I got to get FHA. They have the best rates. They have the best program. It's 3.5% down. Who wants that? That's great. There's really a lot of hidden costs with FHA that nobody talks about, and I have been very vocal about for people, and I just sit them down and I explain the differences for them. Not everybody's going to be able to not go FHA, whether it's debt to income ratios and things like that.
Sure.
The FHA is a lot more lenient as far as approvals.
Yeah.
Maybe they just can't go conventional, but if your choice is between 3% conventional or 3.5% FHA, 3% is less than 3.5%.
Yeah.
It's not just the 3.5% that drives me crazy. A lot of lenders do not mention the upfront mortgage insurance premium. So
Right.
of that loan, let's say you took out a $300,000 loan.
Okay.
You bought the home for $310,000. You put
Ballpark. Yeah.
yeah, there 310.5, whatever it may be, whatever the math on that exactly is, because I didn't think about it. So I'm sitting.
It was actually accurate. Yeah.
Yeah. So that $300,000 loan, you see all your paperwork, shows you your loan amount, everything from there. On day one, that $300,000 loan is actually $304,750
because they're adding a percent and some.
You're adding 1.75%, and I really hope that 1.75% is what I just said. I'm usually good at math. I'm close. I'm close.
I don't care. It's all right.
Yeah, no big deal. You
Perfect
can't. It's not like a Facebook comment.
Nah.
I can't delete this. They got me dead to rights. But that upfront mortgage insurance premium is then added to your loan balance, and that's not talked about too much, and it drives me nuts when people don't talk
Even
about
if you pay it off, like let's say, okay, you got 3.5% down. Now you have that upfront mortgage insurance. What if you got a windfall 6 months later and you put it up down to get 20%? You're still eating that cost.
It's already on
already
day one. It's already there.
So you can't refinance your way out of it.
You can,
okay.
But if you refinance, let's say you can't refinance day one. Sure, you can, but you can't.
You would.
But yeah. So if you were to refinance on day two of owning the home, instead of your loan balance being $300,000 like you thought, it's literally $340 and change.
Yeah.
So it's something that people don't talk about, should be talked about, or at least explained to you.
Yeah.
And the offset of that is the FHA does usually have better rates.
There you
go. The kicker to that is if you're doing 3.5% down, the mortgage insurance that you were talking about, that's for the entirety of the loan.
Yep.
At that point.
With the FHA.
With the FHA.
With the FHA. So
no matter,
that lives with you.
It lives with you. My rate's 3.125, and I'm going to have it till I pay the house off.
On that note, so you can't ever escape that. Let's go back to a normal PMI, no FHA.
Yeah.
Do people ever ask you like, hey, should I overpay my mortgage, get a little bit down toward principal, get to that extra 20%, effectively the opportunity cost of their excess money?
So that's going to be a really good conversation for somebody like yourself.
Yeah,
figure out which way is going to make more sense.
Yep.
If it's the first 5 years, yeah, absolutely. It's gonna,
oh my gosh, all that's
the compound on the backside is going to be immense.
Of course.
Here's the thing. Are you paying extra for the first 5 years, but you're going to sell it at 5 years? Then maybe it doesn't make as much sense.
Yep.
Maybe you want to put that somewhere aside and things along those lines.
Yeah.
But it's very situational. There's no right or wrong answer. It depends on the person.
Very much it depends and how much risk they want to take. Because if you're not going to put it there, right? My big thing is it's the opportunity cost of every dollar.
Yep.
If you have a 3% mortgage, I'm probably not going to overpay it, right? Unless you've got this great interest rate over here that's earning you 5 net free of risk, right?
Yep.
But if you have an interest rate in the 6-7 range, right? Like 7 up there, then you're talking about some serious returns on the back end by overpaying that. So it's always the opportunity cost there.
It can be immense.
Yes, it can, especially when you run those amortization tables and you see how much that is. Because again, right, someone buys a $300,000 house.
Yeah.
If you ask the average person, hey, how much do you think you're going to pay over a 30-year loan on this $300,000 house?
That's it. The total interest paid. There's
no way that they're going to get probably double.
Off the top of my head, at 6.5%, a $300,000 loan probably pays $360 to $380, and that is very rough. So when I say that, I mean over the three.
Over the three. I was like, whoa, that's not that bad.
Yes, I'm sorry. So I should have said 660 to 680.
Yeah.
That is very, very realistic to say.
Absolutely. And you don't know what the market's going to do, but you do have a solid interest rate. That is a guaranteed rate of return versus the fluctuation of the market. So it goes back to your risk tolerance, right?
Absolutely.
So flipping script a little bit. Tell me, do you work with investors, like people who are trying to buy a lot, like accumulate a real estate portfolio, or is a lot of first-time home buyers?
It's actually pretty evenly mixed.
Okay.
Yeah,
Interesting.
It's a lot of, I would say it's a 33 right down the center between investors, first-time home buyers, and people that already bought a home.
Interesting. Has that shifted over time?
Yeah.
Okay.
It's gotten a little bit heavier on the investor side, especially this month.
Yeah.
Everybody wants to be the landlord.
The passive, I've got a lot of people, especially some people in their 20s, 30s that, the FIRE movement, financial independence, recreational employment, retire early, whatever you want to call it.
Yep.
It's like, I need passive income. It's very active to own a home and be a landlord. Would you agree? Unless you have a property
1,000%.
management company, right?
Yeah.
So people are like, I just want to float off, retire, not do anything, and get this passive income.
Yep.
It doesn't feel like there's anything passive. The hassle factor of home ownership, being landlord, is immense.
It's not as easy as everybody thinks.
Yeah. Do you talk with any of your investors about that? Or it's like, hey, you want a mortgage? I'm here for you.
Yeah, all day long.
I would think so.
So a lot of things, I'm very anti-social media. I'm going to post this on every social media. I'm very anti-social media, not social media itself, but the people that are on there. Like, oh yeah, just go house hack and buy this quadplex and it'll make you money. That sounds all really great. But then you're the landlord. So what happens when John Doe rents 1, Jane Doe rents 2, and Johnny Smith rents 3?
Yeah.
But 2 of them just lost their job. They're not paying you rent because they don't have it.
Yep.
So you got to evict them. You got to make your mortgage payment.
Yep.
You got to figure out how to get good paying clients in there. It's not as easy as everybody wants to paint this picture of, oh, this is so easy. Everybody should be doing this. Why aren't you doing this?
And God forbid the roof goes along the way, the HVAC, there's a year of profit, but there's people.
4 hot water heaters.
Yes, there are. There are people who do this and do it very well, right? And I'm sure there's some strategies in place, right? Do you ever see people build an investment portfolio of real estate and then use the equity from each of their properties?
It's happening Monday.
Yeah, there you go. So they're taking the equity out of their existing rentals, primary, whatever it is, and redeploying that capital to expand their portfolio, if you will.
100%.
Okay. All right. Is it just a matter of is it a refinance? Is that what they're doing? Like a cash out refi?
It's a cash out refinance on the investor side. The crazy thing is people always think, oh, well, I'm not working right now, so I can't do that or anything along those lines. DSCRs is what they're called, debt servicing consolidation ratio.
Okay.
You always usually want to have a 1-to-1 ratio of the mortgage payment and the rent. You want to have a lot more, but if you can only get the 1-to-1, then you use the 1-to-1.
Sure.
But what that allows is your credit score to be used. I don't need your income documents, don't need your bank statements, but I do need any of your current mortgage statements, any current homeowners insurance policies that you have for homes, things along those lines. You have to make sure all the mortgages are paid. There's no lates on the mortgage, things like that. And it uses your credit score and the income coming from the property to offset.
That makes sense. Collateralized effectively, right? Extend that now to not someone who owns a bunch of real estate, because it's very similar, but owns a business. Yeah. Right. They have fluctuating income. Do you work with a lot of business owners who W-2, I'd imagine like a salaried employee might be a little easier to approve a mortgage? Yeah, I think so. So tell me about working self-employed.
So for self-employed people, it depends on how they pay their taxes. There's 100 different programs.
Okay.
I'm going to tiptoe along this and say not every self-employed person pays their fair share.
Their taxes. Hey, you don't let the tax go like the dog. Yeah.
But if I go to their business bank account and I see a lot of money flowing in and out, and it doesn't have to be a lot of money, but usually it's, oh yeah, we're just a small business. You did 1.8 million last year, small business. But it depends on their credit score, how much they have down and things along those lines, but there's bank statement loans that are available.
Okay. So that's all you need to look at.
Yeah. You do still have to be up on your taxes and stuff like that, but absolutely.
What are some of the biggest mistakes you've seen, whether it's an investor, a self-employed business owner, a salary, just a first-time home buyer? What are some of the biggest mistakes? And before I even let you answer, I know the one that I have heard since maybe high school. Don't get a new car or a car loan or a loan of any sort before you go get a house.
Oh, this is one of those you should have warned me that you're going to say.
That's fair. But anything that you were going to go to a deal with someone and they're like, oh yeah, by the way, I did this. And it was like, you did what?
I had somebody co-sign for somebody and they thought that it wouldn't matter because they were only co-signing for them.
They didn't think it would be on their own credit.
Yeah. It was 2 weeks before. No, the car dealership said, I was just the co-signer. I'm not liable for the payment. Well, your credit report from TransUnion, Equifax, and Experian says this is your payment.
And that's a DTI impact, right?
Yep.
Oh, yeah.
Another nice thing that people don't realize, and obviously you can't do it on something that was just paid for. But if you are co-signed with somebody, let's say you and your wife are co-signed on whatever you drive.
Sure.
And your car, you've had it for 2 years now, but every payment's made out of your wife's account and you're both on it. I can show through her bank statements the last 12 months and pull it off of your debt to income.
Okay. That's interesting.
Yeah. A lot of people don't know that. So if you take anything from this video, take that.
That's a good one, right? Because that's not something I would realize. And that shows the value of someone like yourself being an expert and knowing that you could do something like that. Because I would just be like, oh, we're kind of screwed over a little bit there.
No, not at all. I think one of the biggest mistakes, I don't even know if we want to call this a mistake. One of the crazier things I've ever seen, going back to social media and why I don't like it.
Yep.
Somebody said, yeah, I've been in my home for 3 years. I paid it off though. Okay. Let me look at this video.
Yep.
This is 6:30 in the morning. Somebody sent it to me. I was like, one-eyeing it for a second. And then I got all fired up. I was like, you liar. Yeah, they paid off their mortgage. They absolutely did, with a first position lien HELOC. I've never heard of something so stupid. You didn't pay you paid your mortgage off for a different style mortgage, a home equity mortgage.
With a higher interest rate usually.
With a higher interest rate.
Yeah.
And if you don't keep rolling them and they have draw periods, you're only paying the interest.
Yep.
You're not amortizing it. You're in 30 years, you're still going to owe on the home what you initially had the mortgage for. So to say, oh yeah, I paid off my mortgage in 3 years. I thought this guy maybe shoved like 30 grand a month at it.
Different way is all you did.
Yeah.
I'm going to hit you with one.
I actually paid my credit card right off.
Yeah.
My other credit.
With my other credit card.
Yeah.
Balance transfer.
That's literally what that is.
Balance
I'm going to make that
transfer.
video on the way off. Absolutely. That's what that was.
I got one more oddball question for you before I let you go today. Kids in high school.
Okay.
They're going to learn anything about credit, debt as it relates to your world.
Where I want to go with this.
What would you teach them? What do you think is important for a kid in high school?
I'd actually rather teach their parents.
Okay. Fair enough. Go ahead.
And I hope everybody in this office tells all parents, but as of 13 years old, you can put your kid on your credit card.
Yes. So yeah.
So major impacts are going to be, they'll already have an 800 score. You may not have to co-sign for their student loans.
Yeah.
Because we do count them. I know that it's shocking, but student loans do get counted against you. Again, it sounds a little mean, but they do get counted in your debt to income.
Yep.
But it will really help them further along the line. Another big thing with credit and kids and everything like that, just teach them money management and don't let them get behind.
Exactly. Yep. Yep. How your credit score works. Adding a kid onto your credit card is something I almost recommend every single young kid, whatever.
Discover, might be 12, but I'm going to say 13 so that at least I'm accurate. And most are 17 or older. Sometimes we'll get people to get the most nominal size student loans just so they can build a little bit of credit history. Right? Even though you're losing a little bit of interest, the credit card route's way better. But even like a nominal loan, something to get you started. Yeah. And then here's another thing. So let's say your kid's going to school and they've been on your credit card since 13. You don't even have to give them the credit card. You don't have to tell them because you're their parent at that time. And when they turn 18, I must have forgot. Nobody's going to come and arrest you or anything along those lines. But they just got they're 22, 23. They just got out of college. They just started their first job. You know what I really want to go? I want to go lease a car. I want to go buy like a little bit of a newer car because you gave me this hand-me-down thing. Well, now they have 10 years of credit history of on-time payments.
Yeah.
On-time payments of credit utilization on revolving debt that was always paid. I used to do special finance for auto sales.
Yeah.
It is such a huge factor.
Well, if that's the only thing you heard, if you got a kid 13 to 20, 18, roughly, you'd say, get them on your credit score.
You can even do it for friends and family. If you know somebody's in a tough spot, maybe they ruin their credit or something like that.
Really? That's interesting. Now that's a leap of faith a little bit, unless they really
I get the card about it.
Yeah, exactly. Yeah. That's a good idea. All right, JJ, it's been an awesome time. Thank you for being on the show. It's an absolute pleasure. JJ, look at the camera, tell people how they can reach you.
It's very simple. Phone number is 215-776-5475, or on just about every social media, it's at JJ Does Mortgages.
That's it. That's it. Well, JJ, thanks again for being here with me, I should say. This has been the Financial Blueprint. I'm your host, Kyle Ryan, and we hope to see you next time.